Here's why we are buying the dip, and you should too. Hey guys, this is Luke Downey. I am covering our latest macro insights by Alec Young, and it is a doozy. We've been big buyers on the dip, telling the whole world when it was on fire, and now we're going to showcase some macro reasons of why we are so constructive on stocks. So the first thing you guys need to realize, this is an incredible chart going back to 1980, and it's showing the average intra-year decline. So these red dots are telling you by year the intraday decline of the S&P 500. Now, the key to this is to let you know that it is very, very normal for us to have a little bit more of a 10% correction each year. The average is about 14%, believe it or not. Now, these green bars, this is telling you the calendar year return. So in general, stocks are up year after year. There are a couple of years where markets don't go up. But you know what? You keep buying great stocks and that's how you win. So again, don't overreact to volatility. This is what happens. Don't buy into the bearish themes because once the rally starts, you're going to miss a lot of the gains. Why else are we buying the dip? Well, let's look at some of the macro factors that are so important. A lot of people are nervous. They're looking at the initial jobless claims. They're saying, oh man, they recently ticked up to 241,000. But did you know that that is 34% below the 60-year average of 364,000? Context is key. And speaking of context, look at the Goldilocks macro setup right now. Here you've got the Fed funds rate basically at 5.33%. You've got US GDP growth, which is really strong, nearly 3%. And then you've got core PCE, that is the Fed's favorite inflation indicator, going lower. So one of these things has to break. Either inflation's going to go up or we know that the Fed funds rate is going to come down. That's what's most likely. And when the Fed starts to cut rates and we're not in a recession, stocks just boom. But why else are we constructive on stocks? It all comes down to the biggest reason of all, and that is earnings growth. You want to know which way stocks are going to go? Follow the earnings. And they have been turning up this year, and that's all that matters. As long as earnings continue to march higher, stocks are going to be doing exactly what they're supposed to do. They are going to follow suit and make new highs. So where should you be looking for potential value? Well, we do know that a lot of growth stocks, they are doing well, and it's because they have this outstanding 20% earnings growth. S&P 500 tech, though, is elevated relative to historical norms. So we want to throw that out there. Same thing with the S&P 500. But if you're looking for potential value areas, you can look at the S&P 500 value, S&P small cap 600, tons of value there. We still haven't made all-time highs yet this year. Also, mid caps are doing very well relative to history. And then also the equal weight is just about where it falls on the PE historical long-term average. So those are the areas you want to be looking for. Believe me, the Mag 7 aren't going to be leading us forever. Nothing lasts forever. You got to be broadening out. But also, let's look at our sector ranks. Right now, we've got utilities, financials, technology, industrials, and real estate, all leading the areas. A couple things to focus on: real estate and utilities. These are yield plays as interest rates are set to decline, and you've got record money market funds that are going to be earning a lot less income in the months and year ahead. People are definitely going to be looking for income related stocks. And so these two areas are going to do very well. Technology's hanging in there. And then of course, financials can be some of your best performing areas whenever rates start to come down. And then last but not least, why do we like industrials? Because of the build out that's going on in this country. These companies are guiding higher, doing very well. So what's the bottom line? You got to be buying these dips, but most importantly, you got to be focused on the best stocks. Most stocks are a waste of your time. History proves that. You got to be focused on the outliers. That's how you win. Think long term. I'll see you next time.